Hello everyone, this is the Smart Money Technician and welcome to another YouTube video. In today's YouTube video, this is rather a very exciting YouTube video because I will be going through my personal trading approach, okay? This is the model that I use on a daily basis. It is so easy once you understand it. It is the quarterly theory ignition trading model. Basically, what you are doing is you are capitalizing the volatility of the 9:30 a.m. when the session equities open, and it is helping you to achieve precision scalping, okay? So the reason why this trading approach is so easy because it has a very narrow trading window. You are only looking to trade from 9:30 a.m. right up to 10:30 a.m. It's a 1 hour time window. Does this mean that the trading window that we're trading can be so narrow and we can make an entire trading career off just 1 hour? If that's what you're asking, absolutely. It is so effective once we share what is in this video. So without any further ado, we'll just go into some basic things. Don't get scared initially if these are things that you're unaware of. They're very simple things. Once you grasp them, you'll see that it is simple. So let's get into the video. So the tenets of the ignition trading model. The first thing that we will look at is the opening range gap, or the RTH gap, which stands for regular trading hours. Okay, so on TradingView, there's a setting that you do over there where you can change it from electronic trading hours, which is what we all usually use, to regular trading hours. Regular trading hours, if you look on the 1 minute, you are going to see that the market closes at 16:14 and then opens at 9:30 a.m. So we are discounting the early session or the pre-market session. We are not looking at the price action there. Okay, so the opening range gap is the distance from the closing price of 16:14 p.m. and the opening price of 9:30 a.m. I will show a visual representation of this when we get into the video, all right? So the next thing that we are going to look at is the first presented fair value gap that forms after the 9:30 open on the 1 minute time frame. You already know the next thing, sequential SMT. We've gone through this many times. Everyone is aware of sequential SMT. You can go back to previous videos if you don't know what sequential SMT is. And you simply just also need a higher time frame bias or a draw on liquidity, okay? So to trade this model, you have a draw on liquidity. You wait for this particular model to form in the direction that you're anticipating, and you simply execute it within the time window of 9:30 to 10:30 a.m. All right, so we're going to get into the charts and show examples of this model in action. All right, so we are currently on the charts at the moment. Now in this video, we're not going to go too much into higher time frame bias or draw on liquidity because in the previous video I've covered that extensively, so you can go back to those videos. But we will mention why we were bearish. You can see that we were bearish because of this monthly cycle sequential S&T on a Monday, and the price confirmed it by expanding in the direction. So coming into Tuesday, we are going to be bearish, right? So I'm going to go to the 1 hour and then I will fast forward the time right up till the time that we are looking to trade. So starting from on the M15, right? What I do is when I am about to enter into the New York sessions Q3 of the 90-minute cycle, I then start to mark out the highs of the 90-minute cycles as well as the highs of the London session as well. But I'm not going to do that because these are the highs that this day used. All right, so we go to the 5-minute time frame. At 9 a.m. price expanded and took out this high of the 90-minute cycles. Now I want to explain something about sequential SMT so that you properly understand it, right? Sequential SMT, whenever price takes out high, this is the asset that does the turtle soup. It also needs to close above the highest close of the quarter. So if you look at this up close candle, this is where it closed over here. This close is the highest close within Q2 of this 90-minute cycle. Therefore, the asset that takes out the high should also close above that close, causing it to be a valid sequential SMT. At the same time, the asset that fails to take out the high needs to not only fail to take out the high, but also fail to close above this close. So there needs to be an SMT between the wicks and the bodies. Can you see that? So if you look at that right there, we have an SMT between the wicks and the bodies. That is a valid SMT. You should keep that in mind. Now, if you watch closely what happens, the next candle closes above the bodies, making this SMT not valid. So it will need another confirmation, right? So when this happens, I can see that it failed to take out the high, but I don't like the fact that it closed above the highest close. So I will go on to the lower time frame. Whenever this happens, you either want to see a TPD form on M5 or a lower time frame sequential SMT, which is what happens. So let's go to the 1 minute time frame. But just before we get to the 1 minute time frame, let me fast forward. Right, so we'll go to the 1 minute time frame. Because we kept in mind that we don't really have a valid SMT, we need to see a second stage here, right? We need a valid SMT to form for this session to be a valid trade. What you do is that you go to you click on the asset. I'm going to show you this. What you do when you're on the 1 minute time frame, right before 9:30, is that on ES and NQ, you want to change this to regular trading hours. I'll do the same thing to ES as well. Regular trading hours, right? Once you have this right, what you want to do is that you want to see where price is going to open. So this is the closing price of the previous day, and we're now going to see where it opens in terms of the regular trading hours time window. So I'm going to play that, and as you can see, what happens up here is that we gap lower. So what you want to do is you take your fib from the closing price of the previous day to the opening price of this current day, and you do the same thing for ES. You don't need to do it on Dow Jones, only on S&P 500 and NASDAQ, right? Then what you do is that you want to measure the distance from the close to the open, that range. I'm going to hold shift on my computer, tap on the screen, and see how long the range is. I can see that it is 162 points. A rule of thumb, whenever the range exceeds more than 75 points, then you are going to be concerned about the 0.25 level and the 0.50 level. So I'm going to mark those levels. And I only use NASDAQ to do this measurement. I don't do it on ES, only on NASDAQ. NASDAQ is the asset that we use to do the measurement. So I will mark the 0.25 level. And I will also do the same for the 0.5 level as well. And I will do it in NASDAQ, in S&P 500 as well. Mark both of those levels, and then I will delete this fib tool just so that it is not a distraction on the charts. Then I will change the time back to electronic trading hours. This will all make sense in a minute, right? So change it back to electronic trading hours for ES and NQ, right? Now 9:30 just opened, right? So once 9:30 opened, we want to see price reach back into this level or this level. So this is the 25 level, this is the 50 level. We want to see it at least reach back into this one or this one. All right, so let's see what happens. And at the same time, while we are trading, we want to wait for the first presented fair value gap to form starting after 9:30. So the first fair value gap that forms on this time window from 9:30 to 10 is going to be salient, and we will mark it and note that. So let's see what happens. So as you can see, we've reached into this 25 level, which is good. And we have also at the same time formed our first initial fair value gap, our first presented fair value gap. So what we're going to do now, we're going to mark that. And we will do the same thing on ES, but ES has not yet, ES actually formed its first presented fair value gap. This is ES first presented fair value gap, so we're going to mark that as well. Right. So from what we can see, this is Q1's high. We've taken that out here, but we have not taken out the high of Q1 on the microcycles. So we do now have a valid sequential SMT as well. You can see this kind of closes above the highest close and also takes out the high, while this one fails to close above the highest close and also fails to take out the actual high. So this is a valid sequential SMT. So what are the rules? The rules are, we want to see our RTH gap level, one of them being hit, check. Did we give a valid sequential SMT? We did, check. Did we form the first initial fair value gap? Check. Now, because this fair value gap over here, as price traded up and finally met all the rules, and we are now above the first presented fair value gap, we want to first wait for price to close below this fair value gap and then act as an inversion fair value gap for a resistance to the downside. And that is when we would look to enter. So we're going to let price play out. Price is playing around the fair value gap, and then it finally closes below it right here. So because it does that, I'm going to trade S&P 500 because it's the asset that made the failure swing, right? So I'm going to take my entry, place it at the first initial fair value gap, and then place your stop loss at the most recent swing high that forms prior to it closing below the first presented fair value gap, right? So that is going to be here. But what I will do is I'll just put it above the bodies. You can put it above the bodies because if it really reaches all the way back to the bodies, it's probably also going to take out the high. So if you want to be very savvy on your stop loss, you can do it that way. Take profit 1:3, and we will create a limit order. Right, so let's see what happens. Trigger into the trade. We'll place the stop loss. We'll place the take profit. And we will see what happens. As you can see, the take profit gets hit. So the rules: valid sequential S&T check. Does price return back to one of the levels on the RTH gap? Check. Does price return to one of the levels on the RTH gap? Check. Do we get that first presented fair value gap? Check. And then do we close below it and use it as resistance? Check. And that's the model, right? There are different variations. However, we'll cover other variations as we go in this tutorial. All right, so coming into the next trading day, we will obviously keep the same bias going into the day. So it's Tuesday, we're going to be having the same bias and we're going to see if price is going to go in our direction, right? So I go to the 1 hour and I'll fast forward to the time. So I'll go to the M15, right? And I can see that price is relatively very far away from the London high. So I'm going to also focus on the 19-minute cycle highs. So I'm going to mark the high. And the reason why I'm marking the high is because I am bearish, right? So with this trading model, you're going to practically be looking for sequential SMTs that happen on either the daily, the 90-minute cycles, or the micro cycles. Those are the three cycles that you will mainly focus on for this particular trading model, right? So we're going to watch that and we're going to see. So all right, so now that it is 9:25, right, and we've not yet taken the side, this tells me that probably the 9:30 volatility injection is probably going to run up and take out one of those highs in one of these assets, right? So I will go to the 1 minute time frame, because right before 9:30 on 9:29, I want to change this window to regular trading hours on NASDAQ, regular trading hours on the S&P 500, right? Then I'm going to see where price opens up. So this is where it opened up, so it gapped down. So I'm going to take my fib from the closing price of the previous day to the opening price of the current day. Do the same thing for S&P 500, close, open, and then what I then do is I measure the distance, holding shift, tapping on the screen, and seeing how big that gap is. It is 48 points. Now, remember what I said, a rule of thumb is that if it exceeds more than 75 points, then you want to focus on the 25 or the 50. But if it is not exceeding that and it is less than 75 points, you're only going to focus in on the 50. You see, there is a very high probability the price will retrace into either the 50% level, but if the gap is so big, then it may only retrace back into the 25 level. But in this case, the gap is not that big, therefore we are going to only mark the 50 level. So I'll do that here, and also do that here. I will remove the fib so that it does not distract me, and I will change it back to electronic trading hours. Right, so I want to see price at least trade up, reach this level, and also at the same time, if a sequential SMT forms and all my rules are met, then I will be looking to take a trade. So let's see what happens. At the same time, also watching if our first initial fair value gap forms. Now I want you to look very closely here. This is the 9:30 candle, and you can see that is a fair value gap in there. This is not the fair value gap that we're going to be looking for. The fair value gap cannot form on the 9:30 candle. It can only form after 9:30. So starting from 9:31 is where you wait for your first fair value gap to form. So this does not count. Keep that in mind. So if you look right now on S&P 500, if we look very closely, we have formed that first fair value gap. We don't use it yet. We're just going to note it because all our rules have not yet been met. So we're just going to keep that in mind and annotate it on the chart. This gap will be important in future price action as price plays out. So let's see what happens. Price also forms its own first fair value gap on NASDAQ as well. So I'm going to also mark it out on NASDAQ. And we will wait for price to see what it does. So as you can see, in the Dow Jones, we have reached the previous quarter's high, while in the other assets we have not. But in this asset, we have also reached that 50 level on the RTH gap. So what do we have? We have sequential SMT, and we just go one time from higher just to check if it is a valid sequential SMT. So as you can see, it trades above the high, but also closes above the highest close, or closing above the bodies. Check. Here we failed to take the high or even close above the highest body, so it is a valid 90-minute cycle sequential SMT. Check. I'll go back to the 1 minute again. The second rule, did we reach in one of these two assets, did we reach that RTH gap level that we marked? Check. So we have two rules. And then did we form that first presented fair value gap? Check. We have it on both assets, right? So the only thing now that we want to see is for price, because when all our rules were met, price was above this level. So that means that we're going to use this level, one of them, as an inversion fair value gap for a resistance to the downside. So now we just want to see if price is willing to close below it. And as you can see, right over here, we have closed below the level, right? So in this case, because I can see that over here, S&P 500 and NASDAQ, I can see that NASDAQ closed below the level, so did S&P 500, but I can see that S&P 500 formed a very close swing high here. So that would mean that in S&P 500, I am going to have a very, very tighter stop loss. So I'm more likely inclined to trade the S&P 500 over the NASDAQ, just because I can see it formed a closer swing high. A swing high is a 3-candle pattern where this swing high in the center is having a lower high to the left and a lower high to the right. So that is a swing high. ICT has taught that this is ICT basic. So I'm going to place the order on the first initial fair value gap, and then I will place the stop above the high or at the high, right? Then take profit will be a 1:3, as you know. Right. We'll place the order and we'll see, do we get triggered into the trade? We're triggered. We'll place the stop loss there. TradingView is always very weird. It never really allows us to place the order, stop loss, and take profit at the time that we are placing the limit order. We can only place it once triggered in the trade, which they should really do well to fix. But anyways, that's beside the point. We're triggered in the trade. Price is trading. It gets very close. Spread could have taken you out if you're not trading futures, if you're trading on a broker. Now we're out of there. It trades lower. And you can see take profit just got hit right there. Now, had you traded the NASDAQ, that would have not been the case. I don't even think you would have hit your take profit, because the way you would have entered in on NASDAQ, right? You would have entered there. Stop loss would have to be minimum here above the bodies of the most recent swing high. And then your take profit would be 1:3. So you would have not yet been triggered. So let's see what happens had you entered NASDAQ. And even if you lose, it doesn't matter. This setup happens every single week, multiple times a week. So you can always just catch another one, right? Look what happens. It eventually comes back and does this, right? So even if you entered NASDAQ and you lost, don't try to re-enter. Don't try to do anything crazy. This setup is very consistent in the long run. You can have full confidence in that I assure you. So anyways, what were the rules? We had the sequential SMT. If you look closely there, right? Sequential SMT, check. Then we had price reaching into the RTH, the regular trading hours gap level, check. We then had the first presented fair value gap check, and then price also now closing below the first presented fair value gap check. And this was in line with our bias, but unfortunately this day price continued trading against us. So if you were lucky and you chose the correct asset, you would have been able to come out of that in a profit. All right, so I'm going to show you another setup. There are so many of these setups if you really go into the price, but I'm going to show you one that was more recent, one from last week. In fact, even within this week, there was multiple of these setups, like I think 2 or 3, right? You can go check that for yourself, right? I'm only going to show you the one from this week, which was Q1 of January, right? So as you can see, we're going to start the day, right? And I'm going to say that we were bullish during this time window, right? Because what had happened is that there were some equal highs that were resting above the marketplace, and it was really seen as a draw on liquidity that we're expecting price to draw towards that level. So that is why this day we were bullish. In fact, Monday even showed a reason to respect what we were anticipating. So we were expecting that Tuesday would be a continuation, right? So price traded into this gap, right? And it respected the gap that was left on the 4-hour from Monday's range. So we were really looking for price to show further upside, right? So now let's get into the charts. I'm going to fast forward to the time when we are going to take the trade, because we don't want to spend too much time on higher time frame bias. right? I'll go to M15, and on the M15, right, we're as you can see, I'll just mark London lows. Then I will also go to the M5 and mark the 19-minute cycle lows. Why am I marking the lows? Because I am bullish, so I'm looking for a bullish sequential S&T, right? So that is why I'm doing this. Right, so now that we have done that, we're going to enter into the time window. So I can see that price is getting relatively close here, but it just misses it by a few. I will go to the 1 minute because 9:30 is about to open up, right? So before 9:30 opens up, as usual, what you do on NASDAQ, you change it to regular trading hours. Do the same thing on S&P 500, regular trading hours, right? Then you want to see the gap that forms. Is it a gap up or is it a gap down? Let's see. So you can see it is a gap up. So what I'm going to do, I'm going to take my fib tool from the closing price of the previous day right up to the opening price of this current day. Do the same thing for S&P 500, right? And then in NASDAQ specifically, I'm going to measure the distance of the gap. So I'm going to say shift, touch the screen and see how far it goes. So I can see that this is around 56, 57 points, which is less than what we said. So it is 75 points or less. Then we only are going to be focused on the 50 level on this fib. So I'm only going to mark the 50 level on my RTH gap, right? My regular trading hours gap. And I'll do the same thing for S&P 500 as well. Then I will delete the fib tool just so that it is not a distraction. Go back to electronic trading hours because we have no business on regular trading hours once we have our level marked. So now from 9:30, we want to see when all our rules are going to be met, right? So I can see that 9:30 open and we've spiked below this low. Whenever that happens, when 9:30 is the candle that spikes below the low, right? I go to the M5 and C just to show it to you properly. Whenever 9:30 is the candle that spikes below the low, it doesn't really need to close because 9:30 is a volatility injection. So sometimes price will be so fast that it doesn't even give enough time to even do the proper valid sequential S&T that we're accustomed to. This is the only scenario, or it was a news, this candle was news that came out, then we don't really need to see it close below. I just want you guys to know that, right? So that happens, right? But we have not yet reached this level yet on the 9:30 opening. So we're going to see if that happens, right? As you can see, a gap forms here, but it is not the first presented fair value gap, as the first presented fair value gap cannot form on 9:30. It only can form on 9:31 and onwards. So we are going to wait for it to form. So I can see that on NASDAQ we formed our first fair value gap, right? So I'm going to mark that right here. And we're getting very close to that level as well. So let's see. And we get so close to it. Now, whenever you see something like this where it gets so close to the level but doesn't touch it, that is enough, right? That is not, it doesn't have to exactly touch the level, but it is literally like a takeaway. That is enough for me to say that it is a valid setup, because let me change this back to regular trading hours just so that you can truly understand this. The whole point of the regular trading hours gap is that when it forms, price usually, let's say you were bearish, price has a high probability of trading back to the 50 level. This is a phenomenon. There's a 70% chance that it will trade back to the 50 level. But in this case, we are not bearish, so we cannot take a trade to this level because we are bullish, right? So we need to remove the constraints that are going to cause our trade to have high resistance to go in our direction. So we at least need to see price to at least get to this level. Then it's like weight has been taken off the trade direction. So that means that price has no reason to go down once it gets this close and fills in most of this gap, right? At the same time, let me change it back to electronic trading hours, right? We have the first presented fair value gap, right? We have sequential S&T when the Dow Jones took out that low. You can see that. And we close above the first presented fair value gap. And we are now interested in using it as a inverse fair value gap. So what will I do? Entry at the level, right? Stop loss at the most recent swing high. And the reason why I put it not here at the swing high, because the wicks are rather large, so price might also use the wick like a fair value gap. So you want to place the stop in a very safe area. Risk to reward 1:3, right? Let's see. We get triggered in on this candle, right? See, so sometimes it's set up so fast the candle literally triggers you in, and we'll place the stop, we'll place the take profit, and then let's see what happens. Prices does not waste any time running to the take profit. This trade took 1, 2, 3, just 4 minutes. Take profit already hit. So you really need to be fast when it comes to this model, right? So as you can see on the S&P 500, we have also formed that first presented fair value gap, right? Now in Nasdaq, we used our first presented fair value gap and we have already significantly moved. So that means that likely for this session, the trade has already panned out, right? But I just want to show you something very special about the first presented fair value gap. It is not a random level that is on the chart, right? So price trades higher, 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 higher. But that level can also be used for future price action. Watch what happens when price gets back into that level. So price touches the level, right? This level that we just marked, right? Show you that it's not just a random level, right? Price gives a reaction off of it, forms its own fair value gap right there. Right? And off to the races price goes. So this level, there are many things that I can show you with it, but it's not really my intention to get too deep into this. But I just want to plant a seed in your head so that you can maybe go and back test it for yourself to see that this level right here is not a random level, right? It is a very, very salient level, and the price or the market may use it in future price action, just as it did over here. But to recap, right, we had our sequential SMT, right? We had sequential SMT when Dow Jones took out the low, check. Then we had price retracing back into the RTH gap level, right? When it filled it over here, almost got it to the pip, check. Then we had the first presented fair value gap, price closing above the first presented fair value gap, then using it as an inverse fair value gap to trade higher, check. All right, so this is the last example that we're going to be doing, right? So coming into this week, we were initially bullish, right? And we had this 4-hour fair value gap that we wanted to see price trade higher, right? And it did so initially, but then price came back and it disrespected this fair value gap, closing below it even, completely showing that the fair value gap is not of substance. So once we saw that, we then said that, okay, then if price has disrespected this fair value gap, it is likely to reach towards the lows, right? And you can see that the lows were unsymmetrical, so they are a high probability draw on liquidity. So as you can see over here, once I saw this, then I said that, okay, we're going to be bearish till we at least get to these lows, as this is the nearest draw on liquidity for the week. So coming into the day, I had that in mind, right? So I'm going to fast forward towards the time. Right, and I'll go to the 15-minute time frame, and I'm going to be marking the highs of London. Why the highs? Because I'm bearish. And at the same time, I'm going to mark out the highs of the 90-minute cycle. So Q2's high of the 90-minute cycle. And keep in mind, guys, this model is from 9:30 all the way to 10:30. It is a 1-hour trading window, right? Right, so we've marked out the highs of the 90-minute cycles, right? So once we have this right, we're going to fast forward towards 9:30 to see what's going to happen. Right, so we go to the 1-minute time frame because 9:30 is just about to open, right? And as usual, we first change it to regular trading hours on ES and NQ. Regular trading hours, right? Then we want to see when 9:30 opens up, whether gap up or gap down. In this case, a gap down. So I'll take my fifth tool from the closing price of the previous day to the opening price of this current day. Do the same thing in ES as well. Closing price, opening price, right? Then what I want to do is on NASDAQ, I want to measure the distance, right? So I'm going to hold Shift, tap on the screen, and I can see that this distance is rather large because it even exceeds 75 points. It's 174 points, which is way over that. So price might just open up and just close in maybe the 25 level. I don't think it's going to get all the way to the 0.5 level. So that's why I'm going to mark both levels instead. So I'm going to mark the 25 level and the 50 level as well. Do that for ES as well. Then as usual, I take the fib so it's not a distraction on the chart, change it back to electronic trading in hours. And now we're going to see what happens on 9:30 time window, right? So we have that level. This level is the 25 level. If I scrunch it up, that's the 50 level. So I want to at least see price in ES or NQ at least get to one of those levels. So on 9:30 time window, you can see that price opens up and rallies immediately past the 90-minute cycle high and the London highs that is over there. This is a two-stage cracking correlation, two-stage sequential SMT happening simultaneously. So if I go to the M5, right, I can very well see that we took out the high and we've also closed above the highest close, which is good. I'm just going to go back to M1. So we already have a valid sequential SMT on the 90-minute cycles. That's all we need, right? Now, the next thing we want to see is, does that first presented fair value gap form? We're going to wait for it to form. Price expands lower, and it forms it on ES and NQ, so I'm going to mark it. The first fair value gap forms on 9:31, right? As I said, it can only form beginning from 9:31. So we're going to mark this out here. So we have the first presented fair value gap formed. Now the only thing that remains is that price at least needs to get to this level so that it doesn't have any weight holding it back, because once it at least has filled in some of the gap, this area is no longer going to be like a magnet that is going to cause price to not go in our direction. So we want to see price at least fill in some of that regular trading hours gap, so at least get to the 0.25 level, because it is rather a large gap. So let's see what happens. Price gets there very nicely, touches the level, reacts off the level, good. Now we want to see, does it close below the first presented fair value gap, because when it touched here, all our rules were met. So since price was above this first presented fair value gap when the rules were met, we want to now see price close below the level and act as an inverse fair value gap. There are times when all the rules are going to be met and then the first presented fair value gap forms in your direction, and you're just going to treat it as a regular fair value gap instead of an inverse fair value gap. We just have not gone through those examples. Those examples are for you to go and backtest and see what I mean. So in this case, it's going to act as an inverse fair value gap because this is now when all the rules are met. Let's see, does it close below it so that we can get that full confirmation. Not yet. Right here on this candle, if you look very closely there, it closes below it by a small tick, but that is still valid. So we can see over here that in NQ, right? Can you see in NQ, the swing high forms over here very close to the level, while over here, this is the most recent swing high. So over here, I'm rather going to trade NQ because I'm going to have a rather small stop loss. So I'm going to place my entry there, stop loss above the most recent swing high prior to the close below the first presented fair value gap. And take profit is going to be 1:3, right? You can see ES is still playing around. I wonder if it's going to form a swing high. Okay, so it also now finally closes below that level, right? So I'm already in on this one. Just let me do that again because I forgot to put the entry, right? So I'm in, stop loss above, take profit 1:3, right? And then we'll see what happens. So I'm in the trade, price immediately starts reacting and starts trading lower, right? Does a little bit of a retracement. And the take profit gets hit. So rules again, sequential SMT that is valid, check. Price retracing, filling in some of the RTH gap, check. When it reaches this level, yes. First presented fair value gap, yes. Do we close below it? Yes. And that's the entry. Very, very simple. From 9:30 all the way to 10.30. You wait for this entry to form in line with your trading direction. Now, is it going to be perfect? Are you going to win all the time? Absolutely not. But you have 100% certainty in yourself that this trading model will win more times than it will lose, and the times that you win, you're at least getting a nice 1:3. So even if you had a 30% win rate, you are still going to be profitable, right? And the reason why I like this trading system is that when I'm wrong, I get immediate feedback that I'm wrong. I don't want to sit the whole day and watch price play around. I am in and I'm out within the session and I'm about my day. This is the trading model that I personally use, and I'm sharing that with you because I feel like being charitable. But I want to also show you again that this level, the first presented fair value gap, is a powerful level. So let's show you that. As you can see, when price finally closed below the first presented fair value gap in ES, let's say you didn't quite get this entry here. If you are still within the 9 to 10.30, right, let's say, if there's still time and price does get back to that level, then sure, I'll put my stop loss above the high of the wick, because this is a long wick. Take profit 1:3. And we're going to sell there, just to show you. I'm going to put the cutoff time at 10:30, right? So let's see. Price trades lower, really lower, but within that time window, gets back into the level, right? So let's see what happens. And it even continues lower. This first presented fair value gap, it's not a random level, folks. It's not a random level. It is a very specific level that the algorithm will refer back into, especially if it still has further objective to the downside. That price can literally just come back and use it. You should go back test that for yourself. Make sure you guys like, comment, and subscribe, guys. I hope you guys enjoyed this video. Cheers, folks.